You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, with a little in the way of fresh U.S. economic data to drive the market in this holiday-shortened week, investors refocused part of their attention on the health of European banks as questions emerged over European bank stress tests. But concern over those European banks was quickly offset by news on Thursday of a better-than-expected drop in the weekly jobless claims to a two-month low, as a matter of fact, and by news that the trade deficit narrowed sharply in July thanks to airplane exports. And the Fed's Beige Book this week report showed that just a reiteration of the word that the subpar economic recovery remains intact. Not a whole lot to go on there. Tracy Reinick, who joins us once again to talk about all this, try and put it in some perspective. You know, there was really no news in that Beige Book this week.
No.
Not a very eventful week. We have low volatility if you look at the VIX. And I find this kind of interesting. Yet a lot of ups and downs with stock prices. So there's this tug of war, it seems, going on between the bulls and the bears here.
Oh yeah, it's still going on. We're still in this narrow trading range, and we can't seem to break out one way or another. It seemed a little more bullish for me this week, though, than what we've been seeing the last couple of weeks. And I say that because we've been having some of this news about Europe, as you said, and we had this news about Deutsche Bank possibly raising $11 billion. And the markets didn't really react that big to it. A little bit of sell-off, but it would have been much worse, a couple months ago.
Well, the Deutsche Bank news comes, I guess, just ahead of the new bank capital rules, global capital rules, kicking in this weekend.
Right. So, but these are the concerns that have been driving the markets, that the banks still have issues.
Right.
And it's not really affecting it. So, to me, that's a little bit more on the bullish side.
But volume still very, very light in the market, even after the holiday. Now, you can't blame it on summer vacations.
I know.
And you can't blame it on the holiday anymore. What is it going to take to jack up this volume?
I don't know. I mean, I am surprised that the volume is low this week, to be honest, because people are back from their breaks. Although it is a 4-day week, and today Wall Street is kind of commemorating the 9/11 because it's on a Saturday this year. So that's always a more subdued day as well. So I don't know. I still think people are waiting for a little bit more economic data to come in the next couple of weeks, and then they're going to be returning to more normal trading volumes.
You wonder if it's just going to take a bigger string, a longer string of positive economic reports, or a macroeconomic event to change that volume.
I don't know, because our reports keep coming in mixed. So maybe that's kind of what's keeping the volumes low here too, because nobody has the momentum one way or another. So yeah, it might take one bigger event to cause people to really get in or get out.
Mike Vodicka, also with us here. Mike, third quarter earnings season, not that far away if you take a look at the calendar. Up to now, we've seen good news on corporate profits. Many companies have reported, some decent earnings surprises, yet stocks of some of those companies don't always perform well on the heels of those earnings surprises. So give us some weekend wisdom on why that might be.
Sure, there's really three primary reasons driving that kind of a situation. The first is estimates versus whisper. And estimates, of course, would be the consensus estimate, a collection of analyst estimates. And then the whisper number, of course, being something referred to as the most accurate estimate, more the sentiment on the street. Second reason would be actual quality of earnings. Where did the earnings come from? Are they sustainable? Is it just a one-time shot? Does it have a lot of transparency into the long-term view? So if the market sees earnings as being unsustainable, it could put a little bit of downward pressure on their share price. Third reason being forward guidance, of course. When companies report, they either lower guidance, hold it steady, or raise. So if a company produces a really solid earnings surprise, but their guidance stays flat or goes down, then you could actually see some downward pressure on their share price off an earnings surprise.
All right, so give me a quick rundown of a couple of ways that investors can make money, even though surprises may not always reflect the stock track.
Yeah, sure. The first way would be, it's a little bit more conservative, would be to wait till the number comes out and then get on board for a nice earnings surprise to enjoy what's called the post-earnings drift, because studies show that companies that do surprise tend to have a 6 to 9 month period where they outperform the market. Second way to do it, a little more riskier, get in before the number. If they do surprise and the share price heads up, you stay on board for the ride. But if they miss and disappoint, bam, you get rid of it, drop your position.
Interesting. Yeah.
A little more risky the second way.
Yeah, just a little bit. Yeah. So we'll leave that decision making up to the investor out there. It's on your radar, Tracy, for the week ahead.
Oh, we're getting a little bit more economic data next week.
Yeah, quite a bit more.
Yeah, the PPI and the CPI. Those are going to be closely watched because that's the inflation-deflation indicator. So far, they've been kind of, showing that there's not inflation, but if that changes, that'll be a big story. You're also getting retail sales, which is another key indicator. Because
kind of interesting that stores have already said this week that they're going to ramp up their holiday hiring.
Yeah, and I do think back to school wasn't a total bust. So I think they're feeling a little more optimistic going into the end of the year.
Interesting. All right, well, we will see both of you back at the Roundtable. We'll see all through the show, as a matter of fact. Stay with us. We hope you stay with us through the entire show as well. There's a lot more interesting information and conversation coming your way here on Profit from the Pros. Here is your Bull and Bears Stock of the Week. A transportation company and a discount retailer make up this week's Bull and Bear of the Week. We're going to get more information on both of those with Shiraz Mian, Research Director, who joins us here once again. So Ryder System is the transportation company that we're talking about. Ticker symbol R. What makes this a bull?
The two main reasons, Terry, for picking it as the bull of the week. The primary reason is the improved outlook for their core business, and the core business being the transportation services and supply chain management. And the second is the very strong finances of this company. They have a solid balance sheet. They pay a good dividend. So these two main reasons. Let me briefly touch on the core business, which is improving. The transportation business, riders in particular, was hit real hard in the so-called Great Recession. And when the economy came out of that recession about a year ago, their business did not really pick up as much as was expected, and we are seeing the earlier signs of pickup in their core business. Primarily what I'm referring to is this thing called commercial rentals, which typically precedes the more longer-lasting leasings. That is the bread and butter of their core business. So we saw these commercial rentals pick up in the first quarter. Folks said, it could be a one-off thing. Then we saw that again in the second quarter, and that's building the momentum, in my view, for a much more sustainable and longer-lasting new transportation cycle for Ryder, which I think will help them produce solid earnings. The fleet utilization numbers have been improving. They beat estimates in both of the last two quarters. Estimates are going up, and typically when estimates go up, we see that the stock price follows. And on top of that, as I mentioned, the solid financials. They pay a very good dividend, currently yielding in the 2.5 to 2.7%. So it's a pretty good story overall.
Okay, and the discount retailer is BJ's Wholesale Club, BJ being the ticker symbol on the New York Exchange. Why is this not such a great performer?
Again, two main reasons. Number one is that the overall macro environment being challenging on the consumer end is heightening and sharpening the competitive pressures for all retailers, BJ in particular. And secondly, coming off of that, the main point, the outlook for the next few quarters on the comps and margins looks quite weak. We know about the stressed out consumer, so I wouldn't belabor that point. The BJ, more so than the other wholesale club operators, they have more exposure to the perishables and food items. They have about 70+% of their sales come from food and perishables versus about 55% for Costco and Sam's Club. So they have more competition with the supermarkets plus Costco and Walmart. And in this heightened competitive environment, those competitors are more aggressive on pricing and promotionals. And in response to that, BJ is kind of scrambling to respond to that. So that's putting pressure on pricing, that's putting pressure on margins, and we see that in estimates coming down for the next quarters.
All right, we got to leave it there. Thanks for stopping by. Stock Talk is next. Stay with us. And now, Stock Talk, analysis of stocks in the news. Well, the number 2 fast food giant Burger King recently agreed to be acquired by Brazilian-backed private equity firm 3G Capital. The deal's valued at $4 billion. 3G, headquartered in New York, will reportedly pay $24 a share for the company. And here to talk about this with us now, once again, Tracy Reineck, Mike Vodicka. So I know Burger King's been struggling through this economic downturn,
Yes.
but were they in the fryer so bad that they really needed this deal?
It depends on who you talk to. They've had a lot of issues with sales and also with problems with their franchises. They are 90% owned by the franchisees own 90% of the
Yes.
restaurants. And they tried to do kind of similar thing on the value menu that McDonald's was doing by offering this $1 double cheeseburger.
Right.
And that didn't go over too well with the franchisees because they were going to lose money on every cheeseburger that they were selling. So they ended up suing, and that ended up being settled. But it's never good when your franchises are suing you, basically.
Yeah.
There's also another issue coming down the pike with restaurant remodel. McDonald's has remodeled a lot of their stores
Yes.
already.
Yep.
Burger King needs to. They know they need to. They have 12,000 stores. They're going to remodel them worldwide. But the remodels are supposed to be anywhere between 300 and 600,000 for each of the franchises to put in.
Mm-hmm.
And there's been some debate on the aesthetic of the remodel. It's going to have chandeliers and look more like a sports bar kind of thing, because this goes with their current strategy of trying to get younger men to come in there and buy the cheeseburgers.
Yeah.
But so far that strategy isn't working all that great.
Well, on the heels of the news, the stock kind of popped up, Mike.
Yes, it did.
I'm assuming that's because the shareholders, franchisees welcomed the deal. What's the 30,000 view from a momentum standpoint?
Burger King share price had been weak for a number of years. On a shorter term basis, this year it had underperformed the S&P. Before the bid came in, shares of Burger King were down about 14% on the year, and the S&P was down about 5%. So it was underperforming. But then when the bid came in, it immediately popped up to $24. So it's kind of a nice thing for the shareholders, of course. So the question moving forward now is going to be: is there going to be any competitive bids? Is the deal going to actually go through? So we could see a little bit of fluctuation in the share price, but for the most part, the shorter term picture, you should see shares trading right around the $23, $24 level as the deal comes closer to being completed.
Yeah, amazing how you can see all that from 30,000 feet up, isn't it? So really, we don't know what's in store at this point. Even though they have a new owner, we don't know what the new owner's plans are.
Not completely. You can kind of extract some things from what 3G has done before, and there's 3 main men who are Brazilian billionaires who kind of dominate 3G, and they've done the takeover thing before with Anheuser-Busch and Ambev. So they're usually in it for a little longer haul. They're not in it to just
Right.
turn it around within a year. They know it's going to take time to turn around. I mean, for instance, 2 years ago, Burger King actually came out with a cologne. It's called the BK Flame. And
I don't remember that.
Yes, it smelled like the Whopper. And that didn't go over too well. But, this is like in the midst of the recession.
I could say something, but I won't.
I know, but so they got to get away from that. They got to have some new menu ideas, which they just announced some breakfast items. So they're
Yeah.
going to kind of go into that direction. But the remodels will help, and it's just going to take time to try to rejuvenate the brand.
Yeah, maybe we'll see hamburgers on a skewer or something.
I don't know.
Servers walking table to table. You just never know about these things. But overall, momentum is flat right now, Mike?
I guess you could say it's flat right now, but before momentum screaming higher up to $24.
Okay. Thanks for being with us. Thank you guys for being here with us. We'll see you at the Roundtable in just a little bit. Don't you go away. There's more still ahead. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Even with all the other news that comes out, even with all of the market ups and downs, it still remains all about the economy. And that's what we're going to continue to talk about here, among other things, at the Roundtable with Tracy Reineck. And we're also joined once again this week by Mike Vodicka and Bill Wilton, all equity strategists par excellence. So one piece of economic news that came out that we didn't mention at the top of the show, folks, is that U.S. wholesale inventory surged by the largest amount in 2 years in the month of July. They jumped 1.3%, the steepest gain since July of 2008, and more than 3 times the increase that analysts had anticipated. Bill, you gave me a very interesting thumbnail analysis of this. This is actually good news, isn't it? Because now inventories are being allowed to build up.
Yeah, I mean, essentially, analysts were expecting the inventories to build by a modest 0.4%, which is still a build and a bullish sign. But when the actual number came out at 1.3, it blew the estimates out of the water. And what that really means is that wholesalers are willing to take on additional risk with the assumption that they are going to be able to go ahead and sell these products later, which is a very good sign. And that's what it is also going to lead to manufacturing buildups and everything that comes down the road.
So inventories being a key component of gross domestic product changes over a business cycle, do you think that this news now paves the way for some wider, stronger economic growth here sometime in the new year?
I wouldn't go that far. It's not going to turn the GDP number around or anything like that, but it is a sign of confidence from wholesalers saying that the consumer front eventually will be getting better in the near future, because these inventories aren't sitting around for years and years. These are generally a pretty quick turnover, so they're saying that maybe this holiday season could be better than they had been anticipating. But as with everything, it's all going to come back to those jobs numbers. So until we see those start improving, that's what's really going to end up giving us a good shift in the GDP.
Tracy, you follow commodities quite extensively. Gold continues to skyrocket. In fact, people who I talk with say that 1,300 is not out of the question as far as gold, and that might just be the first stop to much higher ground. But agricultural commodities are higher as well.
Yeah.
So what's this all? Is this now like the new flight to quality?
Well,
Flight
I don't
to
know.
safety?
I mean, we're seeing 13-year highs in coffee. Cotton is also super hot. Sugar is up 60% in the last couple months. On top of what you were just mentioning with some of the precious metals, coppers is at not record highs, but historically highs for especially this kind of global economy. So these are all like bullish signs, actually. It's not necessarily speculation going in there, as some people might think. I mean, with cotton, for instance, there's real supply and demand issues there with what's happening with the global weather, and the cotton crop is down and demand is up because emerging markets are using much more cotton now. But you're also seeing that in the food area, as you mentioned. Again, as emerging markets, the diet changes and people are demanding different kinds of items to eat. So that's putting pressure on kind of the global agricultural scene as well.
Yeah, so the rising commodity price is still a question mark as to why that's all going on, whether that's going to be interpreted as the flight to safety or not. But Mike, fall, which we are quickly getting into here, is a time when the bears typically emerge in the stock market. Are we going to see that play out again this year?
Well, we haven't seen it happen so far. Of course, volume was really low over the summer, so there was a lot of anticipation moving into the fall season. The traders come back from their big vacations. We haven't really seen a whole lot of volume come back, and the primary reason is because the market hasn't really tipped its hand yet. We do know that there's been a gradual deterioration in a lot of the economic data over the last couple months after rebounding pretty nicely out of 2009. So really the big question mark is, are we going to continue to see deterioration in those numbers? If we do see additional weakness, then yes, the bears are going to come out big time and probably put a lot of downward pressure on the market.
There seems to be a growing consensus developing in the forecasting community that we've got a slower economy for the entire second half of this year. Bill, you echo that?
Well, I mean, that's what the analysts are saying, and generally, it ends up being a self-fulfilling prophecy. If all the experts are saying it's going lower, usually that's what ends up happening. But one, the estimates are coming down, which is a little worrisome. They're looking at about 2.7 for 2010 as a whole. But what really concerns me is that they're looking at 2.4% in 2011, which, if you go back to the heart of the financial crisis, it was, we're going to struggle in 2010, but, in a couple years, maybe 2011, we should be healthy. We should be on track to a nice recovery. So far, we're not seeing that. So it looks like the recovery may just be a little bit longer, a little bit more painful than we had anticipated.
Yeah, that is a good point that you brought up there. Tracy, Time for top stock picks of the week. What's yours?
I picked Rollins, which is a pest control company, and they have Orkin as one of their brands. But I like them because the bed bug thing has really been increased. I know, it's so nasty.
Leave it to Tracy.
I know, but if you're going to call someone, you're going to call someone like Rollins. And they've seen a double-digit growth in 2010 so far, and they're expected to continue that in 2011. And they are worldwide, so they do kind of have a bigger reach.
Okay, Mike?
I was going to talk about Deere & Company. I guess it plays into your conversation about agricultural commodities.
Oh, I thought you were going to say bed bugs. I was going to say, Mike, have you lost your mind?
But I'm sure all the viewers are familiar with Deere. It's a larger company, $29 billion market cap. They have a global brand. And basically, with agriculture prices being elevated right now, the farmers are flush with cash, so they're spending money on their equipment. Deere had a 15% earnings surprise in July. The next year estimates projecting 15% growth. The valuation looks really great here, trading at 15 times. Its peers are at 18, and it's trading at a multi-year high, $69.
All right, Bill?
I'm going to talk about the Cooper companies. Not a household name like any of these other ones that you've heard, but what they do is they provide specialty medical equipment. They've got two subdivisions. One's Cooper Surgical and Cooper Vision. They're coming off a fantastic earnings surprise. They surged right through their 52-week high. So they're trading at or at one of their highest levels, yet their valuations are still pretty enticing. They're trading at 14 times earnings, thanks to a lot of upward estimate revisions. And they're projected to grow pretty quickly, but that's coming at a pretty cheap price as well. PEG ratio is 1.1. Not necessarily a steal, but fairly priced growth.
Okay. Well, thank you all for joining us, and thank you for joining us as well. I heard it put by another analyst this week that the stock market continues to like to climb that wall of worry, and so far there's still enough of that to go around. We'll keep our eyes on it, try and make some sense out of it for you. See you next week on Profit from the Pros.